much more money and upside can this market really deliver?
I don't think much. And I think
you don't think much?
No, not much. You've beaten all expectations this year. You've beaten our expectations. You've beaten every single person that we've talked to. And the Santa Claus rally, I think you've already had it. And when you look into 2020, I think you have to lower expectations. So the VIX is 12, 13. Expectations have ratcheted up. The Fed is liquefying the balance sheet. And we think you're going to get a correction in the first half of next year and possibly the first couple months.
A technical correction, 10%, an actual correction?
We think 5 to 10%, upwards of 10%, yes.
You are the most bearish person I've heard in 2 days. Everyone else has come on the set for 6 hours. You're the only remotely bearish person.
I'm so sorry.
Is that right?
Yes, get out.
For 2 days. So thank you for bringing some sanity and
You're
reason,
welcome.
because things can go wrong. How does the election factor into your sobriety?
Very little. So we would look back to the Nixon era, we look back to the Clinton era, and really it's just noise. Whatever trend you have in place is the trend that continues. So we've seen the equity market march higher. That's what we've seen over the last couple of years. Last couple months. That's what we expect in the short term. But as we go forward, you have to lower your expectations. If you look, please.
But because of the Fed, what's going to be the catalyst that? The Fed looks like it's going to be easy for a while, right? That was what scared everybody a year ago today, and they've taken their foot off that pedal.
Let's roll the clock back 1 year ago. The wheels were falling off the cart.
Yep.
The world looked like it was going to come to an end.
Yep.
And now we're up well over 20% since that point in time. Now everything's fantastic. To your point, I'm one of the few people who have been bearish this year. So you usually don't get great opportunities when everything is good at this juncture. And what's the catalyst? We do think it's the Fed. The Fed is providing a lot more liquidity than they need to. And when that stops and when that decelerates, we think you're going to get a pullback.
James, you keep a close eye on the fixed income market. One of the risks that I have for 2020 is a potential for a sharp rise in interest rates. While not expected, just thinking about what that could do to markets. Is that something that's on your radar? What do you expect for rates in the year to come?
Yeah, I think we've seen the lows globally in interest rates, and I think, as Chris alluded to, the Fed policy mistake that was on the table last year has mercifully been put into the rearview mirror. But I think the upward bias on rates is here. I think we have a labor market that is nearing full employment. We have productivity gains that seem to be stalling in the face of a deceleration of capital expenditure. So the idea that there's going to be some upward pressure to core inflation, I think, is in the market. And I think we've put the lows in for the Treasury yield. We put the lows in globally, by the way. If we look around Germany and other places, we've bounced off the ridiculously negative yields that we had just 12 months ago. So signs do point to a modest increase in long-term rates for us.
What does that mean? Can you give us a number?
I'd say 2.25, 250 is a good entry point for a debt investor.
I'm confused. You mean you expect? Let me ask something much more basic. Dumb journalist. The 10-year yield in 6 months will be where, do you think? If you think rates are going
2.25 to 2.5, I think, is the number that we'll settle into.
Okay, and that would be a good entry point. You wait for that, and then as a bond investor, you get in?
Yeah, and I think one of the things we have to look back on 2019 is pretty much every asset class worked, and that include longer duration fixed income instruments. Now, right now, we can take a pause from our fixed income allocation, not give up a lot of yield because of the short-term rates being relatively high, and sort of let this thing resettle in terms of where long-term rates
James,
is.
just quickly,
that's our trade in the bond market.
They're putting $320 billion into the New York Fed in the overnight repo. I know it's early and it's so wonky, the repo market. It's the plumbing of Wall Street. It's so boring. But $160 billion on the last trading day of this year, $160 billion on the first trading day of next year. Remember that Stephen Mnuchin weekend where he said that? He's like, I've emailed all the bank CEOs and everything's fine. And everybody's like, why did you have to do that? You know, he sort of created almost a mini crisis. Why are they putting $320 billion in the repo market? That sounds like a lot of money. It sounds like something's going wrong that we need to know about, but nobody seems to be that worried about it.
Brian, you make an excellent point. In September, the Fed asked us to wish it away in terms of an imbalance of cash demanded and cash supplied. But as we continue to accelerate Federal Reserve involvement in the repo markets and, in fact, expand the balance sheet, which we view as a QE, the question has to be, is the Fed looking at a repo counterparty that concerns them? And if this is simply a mismatch, it's at best a bad look for the Fed. But if it's somebody saying, I don't want to loan to you overnight, a.k.a. what happened in 2008, that's a lot more concerning. We don't foresee that happening, but it bears watching because somebody may be showing up to the repo market that folks are balking at. That could be a hedge fund. It could be a bank that's teetering. We view short-term markets very closely, and they often are precursors to what can be trouble in the financial system. So it bears watching in 2020 what happens with short-term funding.